This is Macro Horizons, episode 369, Par for the Course, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of April 13th. And a quick glance at the calendar reminds us that, point of fact, Monday the 13th is a lot more frightening when you think about it. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market, by and large, continued to hold the range as incoming headlines from the Middle East help refine the market's expectations for elevated energy prices going forward. The front-month WTI contract managed to move below $100 a barrel, but is effectively hovering at that level. On the data front, we saw disappointing durable goods orders, disappointing ISM services, as well as lower than expected personal income, lower than expected personal spending, downward revisions to Q4 real GDP, and even core CPI came in below anticipated levels. Now, none of this translated into a persistent bid for the Treasury market, and we think that that's more a function of the fact that the primary driver in the macro space at the moment remains the potential fallout from elevated energy prices over the course of the next several months. The solid headline CPI print of 0.9%, as expected, were primarily a function of energy costs. The energy index rose 10.9% in March, which was led by a 21.2% increase in the cost of gasoline, accounting for nearly 3/4 of the monthly gain in overall CPI. For context, this is the largest move on record for gasoline, with data going back to 1967. So it would seem that the immediate fallout from the war in the Middle East has been reflected in the March CPI data, and this begs the question, how is this series going to perform over the course of the next several months? And perhaps more importantly, will there be a pass-through to core measures of inflation? For context, in March, the supercore, or core CPI excluding OER and rent, increased 0.179% for a very benign read. Core services were up 0.225. That was a downshift from the prior month 0.268. And even core goods erred on the benign side at 0.1. versus a 0.08 in the prior month. As a theme, the Treasury market is not taking a great deal of direction from the economic data at the moment, and that's not especially surprising. Given the real-time nature of the developments in the Middle East and the forward implications for the real economy from higher energy prices, it follows intuitively that the dated information within the recent realized data has been discounted. On the supply front, the 3-year auction garnered a pretty solid reception, managing to stop through 1.2 basis points. 10s and 30s, on the other hand, both tailed slightly, each tailing 0.2 of a basis point. Now, that certainly isn't consistent with a weak reception to supply, and rather will characterize it as simply reflecting the still volatile and choppy conditions in the U.S. rates market at the moment. In terms of incoming Fed guidance, the March 18th FOMC meeting minutes noted that some participants judged that there was a strong case for a two-sided description of the committee's future interest rate decisions in the post-meeting statement. So this brings up the notion that the next rate move might not be a cut, but it could, in fact, be a hike. We're certainly cognizant that this is part of the market's broader conversation. It's also worth noting that the FOMC minutes did highlight a dovish risk. In particular, most participants raised the concern that a protracted conflict in the Middle East could lead to a further softening in labor market conditions which could warrant additional rate cuts, as substantially higher oil prices could reduce households' purchasing power, tighten financial conditions, and reduce growth abroad. That's certainly consistent with the impact of prior energy shocks, although we're certainly open to the idea that given U.S. energy independence at this point, this time could be different.
In the wake of March's stronger-than-expected payrolls print, one might have assumed that the Treasury market would have taken its direction from the solid look at hiring last month, coming into the week just past, and in the run-up to what we saw in the CPI report. Alas, that is not what played out, as market sentiment continues to be dictated by the war in Iran and the extension of President Trump's deadline around the ultimatum for Iran to open the Strait of Hormuz or have its civilian infrastructure attacked, ultimately resolved in a 2-week ceasefire that was announced on Tuesday and was enough to bring oil back down below $100 a barrel and moderate the risk of a material escalation of the conflict from here. Now, ultimately, what played out over the balance of the week was a far more conflicting round of headlines around the validity of the ceasefire, whether it was Gulf countries continuing to intercept Iranian missiles and drones, or whether Israel's attacks on southern Lebanon were part of the ceasefire or a violation. To say that there remains no shortage of uncertainty in the region would be an understatement, and while there appears to be some ships making it through the Strait of Hormuz, it's hardly back to business as usual in this critical corridor for the energy sector, and even with a downside surprise in terms of core CPI, it really remains all about the war in driving the direction of the Treasury market and markets more broadly.
And when we put this into the context of what we've seen in terms of the trading range in 10-year Treasury yields, the market still remains in what we'll characterize as a reasonably consistent range anchored near 430 in 10s. Now, this isn't to suggest that there isn't scope or a potential for a repricing in either direction. However, given that some of the key uncertainties related to the war in the Middle East have yet to be resolved, and we'll note that the front-month WTI crude oil contract remains only slightly below $100 a barrel at the moment. So this implies that there's still a fair amount of risk associated from a macro perspective with elevated energy prices for the foreseeable future, and what that could ultimately translate into in terms of a pass-through to core and supercore inflation. The market was somewhat content to dismiss the March core CPI numbers, in part because the headline might have reflected the increase in energy prices, but the core was dated insofar as if there is going to be any pass-through from headline into core, it's not going to occur in the first month, it will be spread out over months to come. The question then becomes, and this is an active debate among market participants at the moment, should one expect April to reveal another roughly 1% gain in headline CPI? That will be a function of how gasoline prices perform over the course of the next several weeks. Given that inflation represents the rate of change, unless we have another material repricing higher, one should expect that April's headline numbers, at least, should be a bit more benign. This feeds into the Fed's argument that this is a one-time price adjustment, and therefore, in light of the volatility of energy prices more broadly, the Fed isn't going to make any monetary policy decisions based on the headline inflation data for the next several months. So with this backdrop, we continue to view any backup in 2-year yields close to the 4% level as a buying opportunity, primarily because we struggle to see the Fed hiking rates this year, and if anything, the most hawkish response would be simply delaying further rate cuts into 2027.
And one of the main debates going on as it relates to the Fed and the ultimate impact of the oil price shock is going to be how that ultimately flows through in terms of growth, in terms of attacks on consumption, and ultimately the labor market. And while we're certainly on board with the idea that it's not just higher gas prices that are going to result from the move higher in crude, but also the negative GDP implications, the timing is important to consider as well. After all, if we learned anything within NFP, it is that in March at least, the consumer was in a relatively solid place to withstand the burden brought on by higher prices at the pump. And so that means as we make our way through April and into May, it probably won't really be until the later part of this month or into next month when we start to see the shift in behavior and growth impact of everything that transpired in March. And so in practical terms, now we're talking about June or July for the release of the actual data that could show a more troubling labor market landscape and get the pricing of more Fed cuts back into the market. The timing around the transition to the new Fed chair is also important, given that Warsh is scheduled, at least, to take the helm in the middle part of May, and so it's entirely possible that his first Fed meeting as chair could be characterized by still solid jobs data and an inflationary picture that has more upside than downside risks, given what's going on in the Middle East. Now, as you mentioned, Ian, this in and of itself would not be enough for the Fed, Warsh included, to actively start considering the potential for rate hikes, but it does reinforce our expectation that at least through the bulk of summer, if not beyond, the Fed is going to be more inclined to be firmly in data dependence mode and evaluate how the economy has responded to all the uncertainty that has played out in the early part of 2026. Because now we have a March payrolls print with a drop in the unemployment rate and inflation risks that still skew toward the upside, which really suggests the Fed will not be in any great rush to do anything.
And an on-hold Fed for the foreseeable future does, to a large extent, anchor the front end of the market precisely where it is, and as a result, we are continuing to view the shape of the yield curve as nothing more than a directional trade. This is an all too familiar environment, especially when we put this in the context of the continued focus on developments in the Middle East. One interesting aspect of the recent price action has been the persistent grind higher in equity valuations despite all the ongoing geopolitical uncertainties. To a large extent, this is surely a welcome development for monetary policymakers because it does take the potential risk for a tightening of financial conditions off the table, at least in the near term, although as we watch the S&P 500 climb back towards 6,900, it strikes us that investors have been very quick to move on from the geopolitical risks while the headlines continue to suggest that the realities on the ground are somewhat different.
But for all of this excitement and uncertainty, what we've seen is that volatility and the MOVE index continue its trend lower off the initial highs that were set at the beginning of the war, which, in addition to equity valuations, has continued to benefit spread products like IG and MBS, as the general sense is that going forward, while there might be blips of things getting worse before they get better, the longer-term trajectory is going to be some form of equilibrium that ultimately shakes out with the strait being some version of navigable. Now, what this means for treasuries and the fact that 10-year yields still find themselves at effectively 4.3% is likely going to be an extension of this trading range, and frankly, from an opportunity perspective, at the current juncture, we like fading either end of that extreme. On the bullish side is a confluence of moving averages and some local yield lows right around 4.2, and meanwhile support for technical reasons and based off buy targets we've heard anecdotally from several types of clients, both domestically and abroad, will be that 4.4% level that represented the bearish extremes we saw again when volatility picked up in the early days of the war and runaway inflationary concerns reached their highest. And so for the time being, we're watching 4.2 to 4.410s until such a time there is a clearer sense on how the situation in the Persian Gulf is going to resolve itself over the longer term. The peace talks in Pakistan may serve as that catalyst, although if the events of the past 4 or 5 weeks have been any indication, it's likely not going to be a straight line in returning to some form of status quo in the region.
Our current approach to the balance of April is to determine whether or not the U.S. rates market has finally reached the inflection point where we stop trading headlines out of the Middle East and start focusing on the incoming fundamental information. This transition is unlikely to occur in the week ahead simply because of the fact that energy prices remain elevated. However, as we think about the final 2 weeks of April, it will be very interesting to see the degree to which the market moves on to the next narrative. It strikes us that the U.S. consumer, while not necessarily flagging per se, might not be on the strongest footing. We did see the downward revisions to Q4 real GDP, putting growth in the final quarter of last year at just 0.5%. Along with that, there were downward revisions to the pace of consumption. We saw real personal spending in February up an uninspired 0.1%, all of which has the Atlanta Fed's GDP now tracking Q1 growth at a similarly uninspired 1.3%. Now, such a pace would certainly represent a downshift from the strength that we saw last year, but given all the cross-currents on the geopolitical front, a downshift in growth doesn't seem unreasonable.
So, maybe 2026, it's not going to be our year.
Yeah, there's always next year. In the week ahead, the market will be focused on the incoming headlines from the Middle East yet again, as some of the talks over the weekend will likely set the tone for early trading in the week. We will hear from a variety of monetary policymakers, which include Barr, Bowman, Williams, Waller, Goolsbee, as well as others who will surely set the tone for the Fed to leave rates on hold on April 29th. This will be the last week for Fed commentary before the blackout period. In addition to the array of Fed speak, we will have the PPI report for the month of March. Given the strength of headline CPI, the market will certainly focus on the producer price index as well. Here, the consensus is for an increase for headline PPI of 1.2%, with the vast majority of that upside driven by energy costs. On the supply side, there's really not much of note in terms of nominal supply. We do on Friday at noon get the primary dealer questionnaire for the upcoming refunding announcement. We'll be interested to see if Bessent is beginning to further lay the groundwork for eventual auction size increases. We're continuing to operate under the assumption that when nominal coupon auction sizes increase, they will occur in the 2, 3, and 5-year sectors and not focus on 10s, 20s, and 30s. Certainly not during the first round, and certainly not at current outright yield levels unless absolutely necessary. As we assess the overall balance of risk at the moment for the Treasury market, there's unquestionably dueling narratives. On one side, the potential hit to growth from higher energy prices, weighing on the consumer, risking tighter financial conditions, and overall undermining purchasing power, have run up against concerns that in the near term, the spike in realized inflation will feed through to core inflation as well as forward inflation expectations. We did see an increase in the University of Michigan's one-year inflation expectations to 4.8%, and that follows intuitively, given the fact that gasoline prices went up more than 20% in the month of March. One of the other wild cards remains the performance of risk assets. As we've noted, we have been very impressed with the ability of U.S. stocks to rebound remarkably off of the recent lows, and the S&P 500, for all intents and purposes, is back to unchanged year to date, which is certainly an achievement when put in the context of the sharp rise in geopolitical uncertainties. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the market continues to chop around in the range, we recall fondly the sage wisdom related to forecasting rates. Yields will go up, yields will go down, but not necessarily in that order. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.